Good morning, good afternoon, and good evening to all of you. As of the very first course of business, let me say a quick note on interpretation. We have English, Spanish, and French participants, and there's a globe icon at the bottom of your screen to select your language. We suggest that you mute the original audio, and with that, let's get started. Thank you for being with us today. My name is Alexandra Haas, and I will be moderating this debate today, organized by the G24 and the Independent Commission for the Reform of International Corporate Taxation. The G24, or the Intergovernmental Group of 24, is a forum to coordinate the positions of developing countries on issues related to international monetary affairs and development, and to achieve a greater role in discussions in relevant global forums. It was initially created as a chapter of the Group of 77. The ICRICT is a group of leaders from around the world who believe that at this moment in history, there is both an urgent need and an unprecedented opportunity to bring about significant reform of the international corporate taxation system. The ICRICT was initiated and is supported by a coalition of civil society organizations and labor organizations, including Oxfam. We are thrilled to be here today at such a crucial moment in the global tax reform. It is not that often that tax is so prominently occupying headlines on the international media. The reason why is the very recent announcement by the G7 on what has been called a historic deal to reform taxation on multinationals, to ensure that those companies pay their fair share and introduce a global minimum tax to end the race to the bottom. However, this deal was not just a G7 decision. It is actually feeding into a long-lasting work led by the OECD under a G20 mandate, where 139 countries are now participating on what is called the inclusive framework. So without ignoring the importance of a consensus by the 7 richest countries in the world, further details remain to be negotiated, and that will happen in the coming 2 weeks. Starting from today, because the inclusive framework is meeting to discuss the details and acceptability of the entire package, and on 9th and 10th of July, when G20 Ministers of Finance will need to decide whether to endorse the deal. Some of our speakers today will be busy, and we are extremely lucky to get them with us today to break down the details of what will be taking place in the coming weeks. We have heard the voice of rich countries, and now it is the time to hear how this will impact emerging and developing economies, as well as average citizens around the planet. So before we get to our speakers, here are some important housekeeping points you'll want to remember. This debate will be a total of 1 hour and 15 minutes. It will be video recorded and will be made available. And the last part of the event will include a Q&A to bring in questions from journalists and the wider audience. Please type your questions by clicking on the Q&A icon, not the chat box on the side. Please provide your name and outlet or organization and who your question is for. You can type your question in English, in French, or in Spanish, and do so as the panelists are speaking. You don't need to wait until the end. Once the panelists have finished speaking, I will read out your questions to them. So let me introduce our very distinguished panel, all of whom are members of the ICRICT. First, we have 2 representatives of G24 countries. Martin Guzman, Minister of Economy in Argentina. Welcome and thank you for joining us today. Unfortunately, Zainab Ahmed, Minister of Finance, Budget and National Planning from Nigeria, is no longer able to join us, but she has asked Matthew Bonjubola to speak on her behalf. Matthew is the director of the Nigerian Federal Inland Revenue Service, and he is also representing Nigeria at the G20 OECD Inclusive Framework, where negotiations are ongoing this week. Thank you for joining us. And 2 representatives from the ICRICT, Jose Antonio Ocampo is the chair of this organization and a professor at Columbia University, is a former Minister of Finance of Colombia and former United Nations Undersecretary General for Economic and Social Affairs. Thank you for joining us today. Our 4th speaker is Jayati Ghosh, She has taught economics at the Nehru University in New Delhi and has been professor of economics at the University of Massachusetts at Amherst in the United States since January 2021. Thank you all for joining us. And so let me jump right into the first question. I will ask each of you to respond in 3 minutes. And the framework is this: the G7 announced their agreement that, let's say, high fanfare. Can we call this a historic moment? The wording mentions fairness and an overhaul of the system. Is that really going to be the case? And especially, is that the case for all countries? And Professor Ocampo, let me start with you. The ICR-ICT has been expressing a critical view on G7 announcements. Could you call this historic, or what do you think we could call historic? We can't hear you.
Yeah.
Thank you.
Yeah, I'm extremely glad to be with all of you today. Let me welcome all of them, in particularly Minister Guzman, who used to, of course, be here in this campus that you see in the background, the campus of Columbia University. And let me, of course, thank the ICRICT team and of course, Mary Lou from the G24 for organizing this meeting. Let me say that I think the G7 agreement was a step forward, but certainly not historic. And that's why we have been arguing from ICRICT that it is, for a historic deal, it is necessary that all multinationals start playing their fair share in the global taxation. And therefore that they should be taxed according to the real activities in each country. Now, the agreement that was reached by the G77 has some, I would say, positive but insufficient advance, and therefore a major weakness in one of the areas that I want to underscore. The first one is in relation to the what is called Pillar 2 in the negotiations. That is the global minimum tax, in which the agreement was that it would be at least 15%. Now this is clearly insufficient in our view. Actually, it's very close to the rates of tax havens like Ireland and Switzerland in Europe. And it's far below the 21%, which had been the proposal of the United States, or the 25%, which is the average tax rate or nominal tax rate for corporations in the OECD, which is the proposal that ICRICT made a couple of years ago. The 21% rate will generate something like $240 billion in revenues, in additional revenues. The 15% only half of that. Now, the proposals on Pillar 1, which is would lead to the principle that countries have the right to tax a certain proportion of multinational profits in the location where they are generated, is even weaker in our view. In this case, actually, the U.S. administration made a relatively weak proposal because it would only allow to tax a small share of what are called residual profits, 10% of the global profits of very large multinationals, those with turnovers over $10 billion. This is extremely low. Actually, there are many proposals from the G24 and actually the African countries to tax a higher share of residual profits, let's say maybe 50%, but also to reduce the threshold for multinationals to have to be subject to this system, or even eliminate altogether a threshold and apply it to all multinationals. We have also been very critical of this concept of dividing the profits of multinationals between routine or core, let's say, profits, and residual profits, which are the ones that would be subject to this system. We think that the profits of a multinational are the result of their global activities of the firms, and therefore that that it should not include only residual, but actually all profits are the basis for taxation. So for those two reasons, we think that we hope that both in the inclusive framework during this next week on the one hand, but also by the G20 when it meets in July, this initial advance that was made by at least making interesting proposals for the negotiations to advance will be complemented by a significant improvement, perhaps adopt the 21% minimum tax rate proposed by the United States, and certainly a different system for Pillar 1, which will allow developing countries to tax many more multinationals that the current proposal would allow countries to do. Let me finish now and continue. Thank you. You are muted, Alexandra.
Thank you. Minister Martin Guzman, thank you for being here. Argentina has also actively been contributing and raising some concerns. What would be your views also for a region like Latin America?
So thank you, Alexandra, and thank you to the G24, Marilu, and everyone for organizing such an enriching panel. I think it's at the right time. Timing is a good one. And Jose Antonio, Professor Ocampo, it's very nice to see the Columbia University background. It looks lovely. So with respect to the question of whether this deal is historic, I think, of course, this is mostly a semantic question. What we are witnessing is a historic discussion, but certainly, in our view, what is being discussed falls very short of what the world needs today to address the challenges that we are facing. We know that over the last 50 years or so, there's been a deterioration in large parts of the world of human conditions. We also have witnessed a deterioration of the environment. Climate change and inequality are two massive problems that we face and we need to deal with. And taxing multinational corporations is a must. It's one of the most toxic aspects of globalization, the illusion and evasion that we are seeing today. So it is historic that this discussion is happening, but we have a long way in order to set rules that make sense for the challenges that we face today. I agree with Professor Ocampo on every single point that he has made, and this is actually Argentina's position at the G20. We are going to have the finance ministers and central bank governors meeting in about 2 weeks in Italy. And this is the position that Argentina is defending. We see problems both when it comes to Pillar 1 and Pillar 2. First, the 15% rate is way too low. There's a substantial risk that the minimum rate will in fact be also the maximum rate, or at least the maximum rate that becomes feasible. And second, when it comes to Pillar 1 and the distribution of the benefits of taxation, we are facing a big risk that there will be an increase in inequality because of the way that the profits will be shared. We think there has to be a principle-based approach to Pillar 1, and that's not what we are seeing now. In our view, we should see a system more closer to what the International Commission, ICRICT, for the reform of international corporate taxation is proposing, basically apportioning profits according to a formula that is based on a number of variables like sales, employment, and capital. And with a minimum global tax rate that is certainly higher, we advocate for more than 15%, certainly not less than 21%, and 25% would be even better. So we hope to continue contributing to this debate in order to, this is the right moment. This is a moment, we are in the midst of a pandemic. There are massive changes that should occur soon, And from Argentina, we will contribute to that debate along the lines that I just described.
Thank you very much, Minister. And Matthew Bonjubola, thank you for joining us today from Nigeria. You have been in the room, in the negotiation room, even co-chairing the Inclusive Framework Steering Group. There you have been able to put forward the views of Nigeria and other African countries, but also the views of G24 members. What have been the common issues raised by countries in the Global South?
Thanks very much, Alexandra. I hope you can hear me.
Yes.
Good. I think the issues of developing countries, including the G24 members, have been very, very common and very, very clear. And that is the fact that the current discussions have not fully addressed the issue of the skewness of the allocation of taxing rights between developed economies and developing economies. And those are the issues that are played out with the issue of the scope of Pillar 1, whereby it is being restricted to about 100 company groups. Is also issues that have to do with the in-country nexus, which are issues. The issues of mandatory and binding dispute resolutions have been issues that have been common to developing countries that have been discussed. The issue of withdrawal of unilateral measures, to what extent and what is the definition of unilateral measure has been a very issue. The issue raised by the minister from Argentina with respect to minimum tax rates, what should it be, had been issues. The issues of extent to which losses should be carried forward, pre-regime losses, post-regime losses have been issues. With Pillar 2, the issues of rule status had been issues. So these are the very, very common areas where the voices of developing countries have been unified, where also lines are being drawn by respective jurisdictions on these issues. If I can add to the initial question as to whether we are having an historic moment or not, well, depending on how we define it, I would say in some way, yes. For example, that the developed world are able to come around and agree on certain elements in itself is historic. We all know what had been happening previously, countries threatening trade sanctions against each other and all of that. And we also know that before now, the discussion around taxing right, allocation of taxing right had been very mooted in most fora, but now it has been openly discussed, and that in itself is historic. However, as to whether the inequality in the current allocation of taxing right has been corrected, my view is that no, it has not been corrected, and the current proposals may not be able to address them. I hope I'm able to respond appropriately. Thank you very much.
Thank you very much. Now, Professor Ghosh, should we be so pessimistic? Do you think the G20 make that deal, the G7 deal, can be made more fair, more inclusive? What would developing countries like to see in this deal going forward?
Thank you very much, Alexandra. And let me say what a privilege it is to be in such an eminent group with so much experience in this matter. I think, the important points have been made already, but I would also just like to underline the urgency of the current situation and the fact that it's not just that, there's an opportunity to be historic, but it's a very small window of opportunity. And really the urgency of the global challenges that Martin Guzman has highlighted are so severe that if we don't make changes to the tax regime very quickly, we could be heading for global disaster. And in that sense, the G7 proposal has been extremely disappointing. So yes, it is historic in terms of recognizing the principle, But the devil is in the detail, and the details are such that they actually undermine that very principle. So if we take pillar one, and this is something, the point that Jose Antonio made at the very beginning, you see, the way they have designed this, they're saying this is going to apply only to the largest firms with global profit margins of at least 10%, and then at least 20% of the residual profit above 10% would be subject to tax in the countries where this is generated. This is so small that it completely undermines the principle. It would generate maybe less than $10 billion globally, and that too, not according to a clearly defined formula that says sales, employment, and assets, as Martin Guzman had mentioned. So developing countries would effectively be denied this, yet this is the major interest of developing countries. This is where they are losing out in terms of tax revenues, this profit shifting, which enables multinationals to move away from the source countries and not provide any tax revenues to the countries which are doing the production and where they have significant sales. So it would affect big giants like, Apple, Facebook, and Google, but it would apply to only a tiny fraction of the global profits of the top 100. And in addition, in fact, if you actually consider a possible reallocation, for example, G24 has asked for a reallocation from 30% upwards to 50% for the most profitable firms. But the ATAF has said, well, we should do this to all multinationals, as the commission ICRICT, which I'm a member, has also been saying, that we should be doing this to multinationals above 100 million or maybe 200 million turnover, and a percentage of all global profits, not making a distinction between routine and residual. Because I would just like to remind you, there's no conceptual basis for a distinction between routine and residual profits. This is not applied in any tax regime anywhere in the world for national taxation. And so suddenly to apply it to this global taxation is something that absolutely doesn't make sense. So we in ICRICT, we would like to see the profits of all multinationals being in scope and allocated not just by reference to sales, but also including employment and assets. And that this would actually establish a more level playing field. At the moment, the likelihood is that, if you get into this, you end up as developing countries getting next to nothing in terms of additional revenues.
Thank you very much, Professor Ghosh. Now let me go into some more detail of things that have been highlighted in the first block of questions. The idea of the global minimum rate sounds like one of the most radical reforms to end the race to the bottom and to the use of tax havens. But there are three challenging elements that you have all highlighted: the rate, the potential exemptions, and/or who will be able to tax first. Now, Minister Guzman, let me go with you. What is your view on setting a global minimum tax rate at 15%? You have mentioned this before. What are the options for a higher rate? The 21%, is that enough? So could you go into further detail about the position of Argentina considering a higher rate?
So thank you, Alexandra. Well, I've referred to this before, but so first let me say that what Professor Ghosh said on the fact that there is a small window of opportunity to achieve something historic, we couldn't agree more. This is a moment. It is positive that we are seeing more content at the multilateral global debate. We have this year a G20 that certainly is addressing issues that matter in a more meaningful way than what we observed over a few previous years, especially during the 4 previous years. And this is something that we have to say that is positive. So we do think that the fact that this is being discussed is a step in the right direction. Going back again to the issue of the tax rate, 15% is too low, and it's not just the problem of the tax rate. It's pillar one, what Professor Ghosh and Professor Ocampo described. The devil is in the details, as Professor Ghosh said, and there is a substantial risk that developing countries basically get nothing in terms of additional revenues. So we have to work on both pillars. This requires the political commitment and will, and to fight against the lobbies that, like in every occasion in which we intend a major reform, become very present. but certainly the world needs today to move faster and through stronger principles, and we would endorse something certainly greater than 15%. We think 21% would be better, and 25% even better.
Thank you. Now, Professor Ghosh, back to you. Do you think there are chances that we can see some of the ICRICT ideas take fruit, bear fruit? Do you think that the 25% minimum tax that you have raised is possible? And could you please just explain a little bit in more detail why the lower rate of 15% is problematic?
Yes, of course. Thank you so much. And once again, I really want to agree strongly with all the points made by Minister Guzman. You know, it is feasible. And I believe that if citizens of the G7 countries themselves knew how much they would be losing by accepting 15%, there would be much greater public demand, even in the developed countries, for this higher rate. So, for example, there's a study by the EU Tax Observatory, which says that a 21% rate would generate an additional euro 100 billion or $122 billion for corporate tax revenues for the 27 European Union countries. But a 15% levy would give you only half that amount. But it's even worse for developing countries. With a 15% tax rate, South Africa would get only 600 million compared to 2 billion with a 21% rate. Brazil would get only 900 million compared to 3.4 billion at a 21% rate. But the point that was made earlier about Africa is also very important. You know, African countries mostly have corporate tax rates of 25 to 35%. So a global tax rate of 15% is not just too low. It will not lead to any reduction in profit shifting. It could even force many countries to actually bring down their rates, the minimum becoming the maximum, so to speak. Across the developing world, we have tax rates significantly higher, which is why ICRICT had suggested 25% as a global average. That's the average of tax rates across the world, the median. Now, in fact, if you had a sort of a minimally ambitious global tax rate, and not even 25, let's say 21%. But if G20 countries were to impose this minimum corporate tax on the global income of their own multinational firms, you would already have more than 90% of worldwide profits being automatically taxed at this rate or more. This doesn't require acceptance by tax havens. We're constantly being told that the tax havens will object. It doesn't matter, because if there is leadership by the largest economies in the world, if they say that's enough, we're not going to have this race to the bottom, we're going to tax at 25% or even 21%, then we would actually have less of the base erosion and profit shifting. There would be no incentive for that. And taxpayers across the world, citizens across the world, and developing countries especially would all benefit.
Thank you, Professor Ghosh. Professor Ocampo, now to you. One of the issues that remains hanging in the air is to which extent we will see a deal on the rate and then a fight on the base. I'm speaking about the G7 communique that it made no mention of whether exceptions or exemptions will be broadly adopted. And that leaves a critical question hanging in the air. It is also a big issue for a country like yours, Colombia. Could you comment on this, please?
Well, thank you very much. Yes, this point is quite important. I mean, let's say a minimum tax rate is important to avoid, tax competition, which is a source of the damage that had been done to the system by low tax jurisdictions or tax havens. Now, whatever minimum tax rate is adopted, it has to be effective, which means that it has to to take into account the tax base and also to avoid a maximum, a large number of incentives of different character that reduce the effective tax rate. Let me, in that regard, point out two things. The first one, which is a response to the people who defend tax competition, is that lower corporate tax rates do not show, or there is no evidence that lower corporate tax rates increase investment. Actually, there is a very important research that was done by the IMF that indicated that at the international level, what lower tax rates do is to bring financial flows, not real investment. So it's a registration, let's say, of financial assets that is done by that mechanism, not additional investment, which, by the way, is very consistent with research, for example, in the United States, of what have been the effects of the large reduction in corporate tax rates that were done, let's say, by Reagan and more recently by President Trump, which indicates that they did not increase investment. What they did increase is dividend payments and actually the repurchase of stocks by the major corporations in order to profit, let's say, from the proposal that or the new tax rules. So the effects of these lower tax rates on investment are not good. Rather, what is very clear is that other conditions that affect investment is what matters. Availability of human capital in countries, availability of infrastructure, adequate, regulations and standards, which, by the way, for example, in the case of both human capital and infrastructure, requires additional government revenues in order to be able to provide for them. So that's the first point. But the second point is that the issue of incentives has to be that reduce the effectiveness of a given tax rate has to be taken into account in the final rules that are adopted in the OECD inclusive framework. And I mean this actually taking into account also debates that are going on all around the world, including in my country, Colombia, where the effective tax rate is much lower than the nominal tax rate, which in our case is 32%, because of a large number of specific incentives, some of which you wonder why the hell they were created in the past, let's say. Anyway, I will not go into that. But in the US, it's the same debate. There was a very interesting recent journal article in the New York Times arguing that the major problem for the Biden administration is not the tax rate. It's actually the amazing amount of incentives that are in the current legislation and which have strong supporters and have to be constrained. So the effective tax rate is what matters. And I will emphasize that point very clearly now. Again, thank you.
Thank you very much, Professor Ocampo. And then I'm going to Matthew. You have been in the room in the negotiation. As I said before, you were co-chairing the Inclusive Framework Steering Group. Regarding the points of views that have been shared in this block about the percentage of the tax rate and the exemptions, what do you think the position of African countries is regarding those issues, and what other common issues between African countries have been raised in the Global South?
Thank you very much. I think as regard issues of the global minimum tax rates, the views of African countries have not been much different from those of other developing countries, particularly jurisdictions from the South Americans and in Asia. Incidentally, quite a number of them are also members of the G24, and the discussions have been very much at the same. Yes, just like the Prof mentioned, the average tax rate globally is about 25-point-something% or thereabout, and the developing countries and particularly African countries have pushed for a rate around 30%, and However, we are aware that the members from the European community have always looked at the tax rate within that community, and which in itself had been probably the benchmark that has been used hitherto. I think it was the current proposal from the US that fairly raised the bar to what is currently being proposed. Howbeit, the point is that in Africa, we know that the tax rate is average is about 28% or thereabout. And so setting the rate this low, there are concerns that it will not achieve the objective of stopping base erosion in Africa, because you find out that the difference between, for example, Nigeria, where the headline rate is 30%. So if you set a minimum rate at 15, you still have a difference of 15. 15 is significant enough for people to engage in base erosion. And we have some African countries with headline rates above 30%. I note that ATAF had raised this concern severally, but it had not been taken into consideration. So answer your questions, indeed, the minimum rate being proposed will not do much benefit to countries in Africa. We also see that it is likely to continually promote base erosion from African countries. As to other issues that may also be joined to that, are also the rules, particularly in Pillar 2, wherein the way the rules are designed, the income inclusion rule appears to be the most favored rules, and such that where taxes not paid in developing countries are going to be paid in developed countries. And this was opposed to the initial understanding and expectation that the countries where those revenue arose should have the first choice of refusal. And then if they now fail to take it up, then it could go elsewhere. But this has largely been ignored, and it's one of the major issues that we are having with the current designs. I think let me stop here so that we can move on. Thank you.
Thank you, Mr. Bonjibola. So before I go into the third block, I would like to remind everyone that you can write your questions in the Q&A section. Please don't write them in the chat. And you can do so as our speakers are responding to the last block of questions, so that we can then move on to responding your questions from the audience. So in the third block, we'll be speaking about how optimistic we can be on reaching a deal in the coming 2 weeks. And let me start with Minister Martin Guzman. Are you confident? Are there specific red lines for Argentina in this case? We can't hear you. Thank you.
Got it. Thank you, Alexandra. Let me offer a holistic view of what we are seeing today and what we see moving forward. Today, as I said before, especially since the end of Bretton Woods, we've been seeing increasing problems when it comes to the global rules for the workings of the international economy. And these problems have led to first, massive increases in inequality within countries. Second, we've been seeing problems for addressing the resolution of a macroeconomic and debt crisis. Third, we have a system of patents and intellectual property rights that has not worked well for maximizing the usages of technological developments. And fourth, we are witnessing significant damage to the planet, seeing the problems for environmental sustainability. Clearly, we need reforms. We need to have the conditions to address the structural transformations when it comes to productive structures that allow all the countries in the world to address the goals of economic and social development. And we are seeing a context of large asymmetries among countries, asymmetries that became more visible in the context of the pandemic. The conditions to deal with the structural transformations in general and with the consequences of the pandemic have been very different for different countries, for advanced economies versus the rest. We need to move to rules that resolve those asymmetries. And there are two ways in which we can finance now the structural transformations that the world needs. One is more tax revenues. So that's why this discussion is so important. And the other is better credit conditions. And what we see today is that there are advanced economies that can borrow at long terms at very low rates, while the non-advanced economies, including many emerging countries and countries in Latin America, like Argentina, don't have that possibility. So for us, we see this in a holistic view, in a comprehensive view. At the G20 this year and at the G7, we should observe progress on both fronts. Progress when it comes to international taxation. We know there is good theory. We know the elements that should constitute the core of the reform. Those elements have been here put on the table. And on the other front, we're also pushing for an adaptation of the credit lines of multilateral development banks. An adaptation in a way that allow us to face the challenges of the 21st century, or at least the first half of the 21st century, and moving forward from the current schemes that were designed in the 20th century. So we are confident that there is enough knowledge, and more knowledge has to be created, of course, to have a proper debate, and we hope to collectively construct the political wills for moving forward in the right direction.
Thank you, Minister. And how about you, Matthew? Do you think we're going to hear big announcements? Do you see a path to a more ambitious deal that would better serve developing economies?
I think where the work stands now, each jurisdiction will have to stand up to be counted. We already have had all the discussions, all the talk, and I think what is expected for each jurisdiction to state clearly whether it is for what is on the table or against. And there's no third option. Now, whether we're going to have a big announcement or not depends on what is big announcement. An agreement of all the 139 countries will be a big announcement. A non-agreement, in my view, we also call it a big announcement. So it depends on what we see as a big announcement. But for me, what is important is for each country to be able to look at what is on the table and see whether it can live with it or not. Thank you.
Thank you, Matthew. Professor Ghosh, in your view, and considering the ICRICT review process, what are the potential pitfalls for developing countries in these negotiations?
You know, I have the greatest sympathy for developing country negotiators in this process, because it's really such a dilemma that you can sign up to the deal because you accept the principle and get very, very little or almost nothing. And people will say, why are you even bothering? Or you don't sign up to the deal, in which case even that principle is abandoned. I mean, it's a really small tightrope, and it's very unfortunate because, as I said, you know, this is a small window of opportunity. The negotiations have raised the principle repeatedly. Developing countries within the OECD process have also been constantly raising these issues. Unfortunately, it really looks like the governments of the advanced countries are privileging the interests of the multinationals based within their border, headquartered in their borders, above their own people and above the interests of the rest of the world as well. So I think it's really sad that G7 governments appear to have sacrificed the interests of the entire world's population, including their own citizenry, for the interests of a few multinationals. And that is the way in which it's going. I worry that there's a very strong risk that the final agreement is not just deeply inadequate, but that it will generate very little additional revenue, so that the principle it's set also will be seen as not that important, and that it would not just reinforce, but even aggravate the inequality of taxing rights between North and South. So I think there are real concerns, and I think developing countries need to band together and get this across to people everywhere in the world, not just in their own countries, but even in developed countries, that the governments are sacrificing massive amounts of tax revenue only to benefit a very, very small number of extremely rich multinationals.
Thank you, Professor Ghosh. Professor Ocampo, to close this round of questions, we have been here nearly 8 years trying to make multinationals pay their fair share. Is this the end of the road for reforming the way in which multinationals are taxed? Is it really now or never?
Well, first of all, I really hope that in the negotiations going on now and the ones that will take place in the G20 in July, there will be a significant improvement in the proposal. I see some developed countries actually on board also for a higher tax. I mean, the U.S. of course had proposed a higher effective tax rate of 21%. But I also remember the Minister of France saying that the 15% was insufficient; it had to be raised. So and we have to see what is the capacity of developing countries to negotiate a better a Pillar 1 deal, which is, as we have all pointed out today, very frustrating. In any case, this is not the end of the road. I mean, this is a one agreement, and as the one we had in 2006 and generated a new convention on that was signed by many countries, unfortunately not by the United States, which is was another advance. And I think we are in the process of continuing to improvement, which I think I hope will look forwards. By the way, one basic point that has been pointed out by ICRICT, but also by the United Nations Panel on Financial Integrity that presented its report in February, and which I was a member also, and actually coordinated the part on taxation that was done by that panel. In any case, both have proposed that the issue of international tax negotiations or coordination, let's say, should take place in the United Nations, not under the OECD, because the United Nations is more fully representative of countries in the world, but also because I think the UN and even some Bretton Woods institutions have been more neutral on these debates than OECD itself. So the Secretariat matters also on these issues, and for that reason, let me say that the issue of an intergovernmental organ on international tax cooperation in the United Nations would be the best institutional mechanism going forward. I mean, the expert committee has done a good job, an excellent job, I would say, but it's clearly insufficient in this area, and having had the intergovernmental process in the OECD, doesn't quite make sense from the point of view of world economic governance. So I hope we can also. And by the way, a final point that was underscored actually by the UN panel on financial integrity, and which is not quite well covered in the current negotiations, is how capital gains are going to be taxed. By the way, a big topic also in the current tax debates in the United States regarding the Biden proposals for a new tax system. It is quite clear that capital gains are significantly under-taxed everywhere, including also because of the inheritance tax that in some cases exempt capital gains from being adequately taxed. And for that reason, this is another topic that has to be in the agenda. I hope the minimum tax rate applies at least to capital gains in the current negotiations, but I think this is an issue that has to be negotiated much more going forward.
Thank you, Professor Ocampo. Thank you all for the 3 blocks. And now we're going to move on to the questions from the audience. And let me start with this question by Augusta Saraiva from Bloomberg News for Minister Guzman. One of the ways in which Argentina has worked to reduce deficit is by raising taxes. In which ways would a global minimum corporate tax benefit your country, considering Argentina's corporate tax is much higher than the proposed global one?
So thank you for the question. This is an important one. What I can say is that if a multilateral compromise is achieved, it would be imperative for Argentina to see a reasonable way to consider the application of unilateral tax measures.
Thank you, Minister. The second question is for Professor Ghosh from Miguel Ramirez from Impestum from Mexico. And he asked, how much would Mexico or Latin America collect with a 15, 21, or 25% corporate tax rate?
Thank you. Yes, well, we do have some information on this from the EU Tax Observatory, which is led by Gabriel Zuckman, who is also a member of the ICRICT Commission. So for Mexico, at 15%, it would only be $500 million of additional tax revenue. At 21%, it would be 0.9 billion, so almost $1 billion. And at 25%, it would be 1.3 billion. In other words, 2.5 times what you would get at 15%. But let's look at some other Latin American countries, Chile, for example. With 15%, only 0.2 billion, very, very little additional taxation. But at 21%, 0.8 billion. In other words, 4 times what you would get otherwise. And at 25%, 1.2 billion. So 6 times what you would be getting. The differences are massive with just these apparently not so big differences in the tax rate. And across Latin America, across the developing world, there is a huge sense in which the 15% could even undermine existing tax collections because of that real danger that the minimum becomes the maximum.
Thank you for this very valuable information, Professor Ghosh. I'm sure everybody wants to know what the impact on their own countries is. So this third question is for Matthew. We understand that the reallocation of taxing rights under Pillar 1 will likely require a form of mandatory arbitration, something that developing countries have not yet in the past favored. What is your view on this?
Yes, thank you very much, Alexandra. I think the developing countries on the inclusive framework have been very clear that they were not prepared to do mandatory binding dispute resolution, which by discussions that are happening private to speaks to mandatory arbitration. And the issue of mandatory arbitration didn't just start now. It had always been on the table, even while discussing BEPS 2013, wherein some countries wanted to replace the mutual agreement procedure, MAP, with an arbitration process. I think the concerns of developing countries as regard mandatory binding dispute resolution regime is hinged on some fundamental issues. One is some countries have constitutional limitations that would not allow them to subject tax revenue to arbitration outside the domestic legislative framework or justice system. Two is that the experience of developing countries with respect to arbitral awards in other cases had sort of made it a no-go area for political leadership in these countries. I know South Africa had a very difficult experience, and Nigeria had one about 2 years ago, which we still have issues trying to resolve. And knowing that those arbitral awards were considered to be outrageous and there was no show of fairness. The third reason why many developing countries are opposed are the fact that it's going to require a lot of costs to do, because we know that most of arbitrage sittings don't sit in developing countries. They sit in the cities of London and Washington and all the big cities of the world. And that means that if I have, for example, a tax dispute of 20,000 US dollars, the cost for me to seek arbitral process in wherever it is outside Nigeria may outweigh the revenue that I am supposed to get. Whereas if I subject that to my domestic justice system, it will be within my manageable limit. So these are some of the issues that developing countries, including Nigeria, have against issues of mandatory binding dispute resolution mechanism. Thank you.
Thank you, Matthew. Let me very quickly ask a question from the Financial Times to Minister Martin Guzman. I know that we're very short on time right now, but I do want to ask you, why do you think that developing countries' interests and needs have not been adequately reflected in the deal so far?
Well, no, there is a simple answer to that. This is a matter of power relations. And that's why it's so important that developing countries come together and with the discussion on the basis of all the knowledge that has been produced over the last few years on this very important matter.
Thank you, Minister. The next question from the Financial Times is for Matthew. What is the possibility that developing countries who are members of the inclusive framework will not sign up to the current proposals on the table, or maybe will only sign up to one of the pillars?
It's difficult to speak in terms of percentages or probabilities. Like I've alluded before, I think we've reached a level where each country would need to stand and speak for itself and understand how the proposals will affect its economic circumstances and its tax revenue. And so I know there are quite a number of countries that have raised their concerns against some of the elements, but we also are aware that there are political pressures also being mounted. There are diplomatic shuttles all over the globe going around as we speak to convince people to sign up. I think my admonition to developing countries will be to take a deep breath before saying yes or no.
Thank you. Thank you, Matthew. Professor Ghosh, from the Financial Times as well, do developing countries have any leverage in the negotiations that they can bring to bear on negotiations? And if so, will they? Perhaps, for example, digital service taxes?
Well, some countries in the developing world have already imposed digital service taxes, India, for example, and a few others. But as you know, this is already a subject of a case in the WTO brought by the US against such countries as being anti-trade. So there are concerns. In fact, that's about all the leverage that developing countries have at the moment, is to try and impose unilaterally taxes. But I think that if sufficient numbers of large developing countries did that, that would actually operate as at least, if not decisive, but a significant pressure point. And perhaps we need greater unity among developing countries to do this together rather than individually to make this work.
Thank you so much, Professor Ghosh. Well, let me thank everybody, the panelists, the audience, everybody that has been connected today. I think we're out of questions from the audience, but I wanted to remind everybody that we will have available, the session will be available on YouTube from the Tax Justice Network website and on the G24 website. And then I would just like to ask if the four speakers would like to give some concluding remarks. Minister Guzman, let me start by you.
Alexandra, just to say thank you to the G24 for all the great work that is conducting, and to Marilu especially, and to the ICRICT for contributing to the work, the kind of knowledge that we need to have a proper, well-informed debate. This is, as I said before, it's a timely meeting, and we will be continuing with these issues at the G20 meeting in Venice in just a matter of days. Thank you very much to all of you who attended today as well.
Thank you so much, Minister. Professor Ocampo, do you want to give us some concluding remarks?
Well, let me perhaps emphasize again that this is not the end of the road. I really hope the final agreement this time will be better. The 2016 agreement was good. I mean, it was a step forward on the convention that was signed. So I think this is another improvement, but we have to continue the international discussion. And let me say that we will, I mean, first of all, that it has been excellent that the G24 has been involved in these negotiations as a group, because I remember a couple of years ago, before this started, that the views of developing countries were minimal in the negotiations. So the G24 as a group has played a positive role, which I hope it will continue to play in the future. Anyway, we have to continue discussing issues like the institutional framework for this, as I pointed out, as well as the issue of capital gains and many others that are in the international tax agenda that require some significant improvements.
Thank you, Professor Ocampo. Professor Ghosh, any concluding remarks, please?
Well, thank you. You know, I agree with the others that this is a process, but I think it's a process that requires much more people's awareness, because tax is seen as such a technical issue, and because, in fact, so much of the details in the negotiation are not understood by the average citizen. A lot of things get by where governments are really shortchanging their own people in the interests of multinational corporations headquartered in their own jurisdictions. And that's unfortunate, but it can be undermined if enough people know about this. And I would repeat, it's not just in the developing world. Of course, it's important for the developing world, but it's also important in the advanced countries where people are not aware of how much they are losing out because of these apparently minor things that are going on in the global tax negotiations. So I really would make a plea to everyone who's listening to go out there and explain this and spread the word about what's going on.
Thank you, Professor Ghosh. Now, Matthew, for closing remarks, the last ones. Thank you.
Yeah, thank you very much, Alexandra, and thanks, listeners. I think what I would want to say is that every developing country should take this work very seriously. The inclusive framework is going to be meeting in a matter of weeks from now to take final decisions. Look at the elements and make very rational economic decision and not just political decision. Thank you.
Thank you so much. Many thanks to everyone who has been here with us today, especially to our brilliant speakers for their generosity in sharing their time when their agendas are so busy. On behalf of the ICRICT and of the G24, I would like to thank all, including the journalists that have been here with us. Your voice, your analysis, and your critical understanding of the challenges of this global tax reform will help greatly in how it gets understood everywhere, to Professor Ghosh's point. Do not hesitate to get back to any of us in search for more information. We will all be following closely the developments. And let me just add, from Oxfam's side, we simply cannot afford a global tax deal that creates more inequalities between and within countries. This is an ultimate chance to address historic imbalances on international tax systems. We could simply not miss it. Thank you very much, everybody, and have a great day.
Thank you. Bye-bye.